Hello everyone, this is Harish. I have over 25 years of experience in financial markets. Today we'll be discussing ADRs, that is American Depository Receipts, and GDRs, which is Global Depository Receipts. These are two powerful tools that allow companies to tap into international markets. We'll explore what they are, how they work, and their impact in global finance with examples from both India and abroad. Let's get started. So depository receipts are financial instruments that represent ownership in shares of foreign companies. Now usually if investors from a country want to invest in a foreign company, it's very difficult. There are regulations, there is jurisdiction around ownership, and so on and so on. What depository receipts do is they allow investors to trade and invest in foreign stocks without directly owning the physical shares or dealing with the complexities of cross-border trading. In a very simple way, depository receipts are receipts which represent the shares in a foreign company. Let's get understanding in a better way by defining it. Let's say a company wants to issue or raise capital from a foreign country. What it does, it involves a bank which will issue receipts that actually represent these shares which are traded or issued by the company. There are two main types of depository receipts. One is the global depository receipts and the other one is the American depository receipts. Now global, as the word suggests, is these are issued and traded outside the country's home country, but not in US. If it's US, it will be called as American depository receipts. If it's anywhere else, say Europe or Asia, it would be global depository receipts. Yeah? Now, let's try and differentiate between the two apart from the fact that it's America or non-America. So ADRs are issued in the US markets, whereas GDRs are issued globally in markets other than the US. American depository receipts or ADRs are traded in dollars, and GDRs obviously are traded in any other foreign currency. ADRs are primarily for the US investors, whereas GDRs caters to the investors worldwide. ADRs can be listed on the American stock exchanges, whereas GDRs are typically listed on the European stock exchange. Given the fact that ADRs are in US, they are regulated by the US Securities and Exchange Commission, whereas GDRs are regulated by the securities market regulator of that particular issuing country. ADRs require sponsorship from a US based bank, and GDRs need a sponsoring bank based in the country where it's listed. Now what is sponsorship or sponsored GDRs or ADRs? We'll talk about it as we go along. Finally, the dividends on ADRs are paid in US dollars, whereas GDR, it's the country, it's the currency in which the GDRs are traded and issued in the country where the local currency is, it will be paid in the local currency. ADRs are typically used by foreign companies to raise capital in the US, whereas GDRs are used by companies to raise capital globally. Let's look at the broad commercial steps involved in the ADR issue, or for that matter in a GDR issue as well. But for the sake of simplicity, let's take ADR as an example here. So what we are talking about is an Indian company wants to issue or raise capital in the US using depository receipts, right? And there are many examples. If you look at Infosys, HDFC Bank, ICICI Bank, all of these blue chip companies have issued ADRs and are traded on the American exchanges. So the way it works is that the Indian company would issue equity shares denominated in rupees to a depository. Let's say, I'm taking it as just as an example, let's say JP Morgan depository in the US, right? The custodian in India. Now, what is a custodian? A custodian is an institution that safekeeps these securities for the issuing company or the shareholders, basically, right? So coming back to the process, a custodian in India would hold these shares with them, right? Now, the depository whose shares are being held by the custodian locally here in India would issue dollar-denominated ADRs which represent these shares. Yeah. So what we are talking about is that the depository bank in the US holding these shares is issuing certain receipts which represent these holdings. Yeah. Now the ratio could differ. So it could be one depository receipt against 2 equity shares, right? And based on these receipts, now these receipts are then publicly issued in the US with investment bankers or with the idea of reaching out to the retail investors. So if you look at the process so far, an Indian company has issued shares in the Indian market where a custodian has kept these shares. The depository bank issues depository receipts which represent these shares and is selling these depository receipts to people in US. Once the people in US, the investors subscribe to these ADRs are then listed on the US stock exchanges for them to be able to trade, right? Given the fact that there are 2 countries involved, 2 currencies involved, obviously there's going to be a currency fluctuation risk. The foreign investors bear the risk as far as the currency exchange rates are concerned. The company would pay dividends to the depository in rupees. The depository would then distribute these dividends to the US investors in dollars, right? So if you look at the entire process, we have created a layer in between the company and the ultimate investor. That's the depository. So it's the company who is issuing shares to the depository, and the depository is in turn issuing depository receipts to the investor. Same thing for the dividends. The company gives dividend to the depository, and the depository then gives dividend to the investors. Given the fact that the issuing company is an Indian company, it is not just regulated by the Indian regulatory agencies, but given the fact that it's now raised capital in the US, it will also have to adhere to the exchange and the SEC requirements and comply with their accounting standards as well. Now let's look at some of the advantages of investing in depository receipts, or very popularly called as DRs. So the first advantage is global investment access. DRs allow investors to access international markets and invest in foreign companies without the need to navigate foreign exchanges and currencies. An investor sitting in US or in Europe is now able to invest in a company like Infosys or ICICI Bank here in India without having to be in India or go through the regulatory process here. The another advantage of DRs is the liquidity. Given the fact that DRs are traded on the major stock exchanges, there is an ease of buying and selling DRs, providing liquidity to the investors. Diversification. DRs enable investors to diversify their portfolios across different geographies now. They are able to invest in multiple countries, multiple companies, and hence able to diversify their investment. Finally, access to emerging markets. DRs enable investors to invest in companies from the emerging markets. Let's take an example, an emerging markets like a Taiwan or a Brazil. It may be very difficult for someone sitting in Europe or America to be able to invest in a local company in Taiwan or Brazil. Here's where DRs come into play and enable the investors to invest in these companies and without having to be worried about the liquidity or the local regulatory requirements of those countries. Now let's look at the disadvantages of DRs. First and foremost is the exchange rate fluctuations. Given the fact that the company is issuing the shares in one currency and it's been traded in another currency, there will obviously be exchange risk available. There will be fluctuations irrespective of the fact that the company is performing consistently. So there are mechanisms to mitigate the exchange risk, but this definitely poses a risk to the investors who have invested in DRs. Country risk. Investing in foreign companies involves exposure to the economic and the political risks of the country in which the company is based. So a US investor is subject to any political, economic or any business risk that may be local to the country in which the shares have been issued. Fees. The depository receipts, and we've already established that there is a layer in between, which is the depository bank. So if the depository bank is issuing these depository receipts, there will obviously be an element of cost. So there is a fee that is payable by the investors for the trading, the conversion and the custodial services for holding these DRs. Finally, the voting rights. The depository receipts have limited or no voting rights compared to the direct shareholding in the company. So these are DRs, they are representing the shares of the company but do not have any voting rights attached to those. Now let's look at the types of depository receipts. In the beginning I had mentioned this word sponsored. What are sponsored DRs? Sponsored DRs are issued with the active involvement and the support of the foreign company whose shares underlie the DR program. In other words, the foreign company plays a direct role in establishing and managing this entire issue process, often working closely with the depository bank to ensure there is proper execution and there is a trading as well as a settlement mechanism in place. For example, if Infosys is issuing DRs in the US, the company Infosys will be constantly in touch with the depository bank and ensuring that an entire program is properly managed and executed, be it right from the time of issuance of the shares to the depository bank, to the depository bank ensuring there is listing and trading as far as these DRs are concerned. On the other hand, unsponsored depository receipt, as the word suggests, there is no active participation or endorsement by the foreign company. So unsponsored depository receipts, as the name suggests, do not have any active participation or endorsement of the foreign company. The issuing company has no role to play. It's only the depository bank that is issuing these DRs and enabling trading and settlement of these DRs. There is no involvement whatsoever of the company that has issued these shares. The issuance of the unsponsored DRs is initiated by a financial institution without the formal approval or collaboration of the foreign company.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.